So Chris, Aiden Hutchinson last night gets sent to football purgatory. Almost, like such a good player and a seemingly good kid. You see him put that Lions hat on.
It's it depends on who you believe. Actually, so Aiden Hutchinson, not everybody's a big football fan, but projected number 1 or number 2 draft pick, taken number 2 by the Lions. He was actually golfing at my course on Sunday.
Oh, really?
So, yeah. So I came in to hang out with some of the guys I was going to golf with, but got tied up. And stopping at the turn window between number 9 and number 10 is Aiden Hutchinson. He was actually throwing out the first pitch at the Detroit Tigers game that night. He was supposed to throw it out for the night before when Miguel Cabrera was hopefully going to hit his 3,000th hit, but he got rained out, and so he got bumped out of the next day. So apparently he decided to take some golfing in my backyard.
Nice.
Quite fun. But yes, getting drafted by the Lions is any celebration that any player has about that is completely fabricated and fake. Lions fans were very happy about it, but there's a saying here, if you're a Detroit Lions fan, that the draft is our Super Bowl. We've never actually been to the Super Bowl, so that's our one shining great moment of the year is the promise of hope, which usually takes a few weeks or months to completely fade away.
Yeah, I don't know why I'm making fun of the Lions, because the Browns, are the same story exactly, really. Outside of, last couple of years have been, I guess, a little better, but
yeah. Lots of stuff to be excited about. Rob, you're looking good.
Very Gandhi-esque look today, Rob.
Rob, does this answer the question about whether you're still in Hawaii?
I am, and I'm about to give you guys a nice little tour. But the internet didn't work out there as I had hoped. So unfortunately, you've got me sitting in a living room. But yeah, somebody saw my commentary today about Lay Day on Sunday and said, I'll buy you a drink in New York if you have a plumeria in your ear, because plumeria are used mostly for lays. And so I'm like, well, if she's going to buy me a drink, I can't pass that up.
New York sounds like a $28 drink, right?
Exactly. So it's worth $28 for me to sit here with a flower in my hand. So you guys remember Peter, Paul, and Mary?
Yeah.
Well, yeah. Leaving on a jet plane. Mm-hmm. But they also did Puff the Magic Dragon. So Rich, this is right up your alley, because that's thought to be a big drug song. So if you remember the lyrics of Puff the Magic Dragon, they mention a land called Honolulu. And I am overlooking Honolulu Bay, and I am overlooking Puff the Magic Dragon. So I'm gonna shine this out here. And
oh wow,
you can, well, first of all, it's just a gorgeous area.
Wow.
But if you look at that, you can see that eye. So that's the dragon's head, Puff the Magic Dragon. And then the dragon is laying down, that's its eye. And the rest of the dragon goes up, and that's the spine of the dragon up there.
Man,
wow.
you really got to be high to see that, because I don't see it.
Well, there's the snout. The snout's on the right. There's the eye. That's the head of the dragon.
Okay. All right. Hey.
Anyway,
I like it. Pretty wild.
It's a pretty magical place.
Excellent. Well, happy Friday, everyone. Rich Swerbinsky here once again with the rundown with Rob and Rich, where we take you into the weekend by running through the week that was in the wild and wacky mortgage industry. As always, pleased to be joined by my co-host. No necktie this week, Rob Chrisman.
Yeah, it's a 3-ring circus out there, and we've got ringside seats, right?
Uh-huh.
It really is. It really is. And this week, with all the tumult in the capital markets and the elevated mortgage rates that continues to be the number one story in the industry, decided to go back to our go-to on all things rates and capital markets, the founder, president of Vice Capital Markets out of Michigan, our favorite Buckeye fan, Chris Bennett.
Thanks, Rich. Always great to be on camera with you to get some FaceTime together. Hopefully next time it'll be in person.
And yeah, all seriousness, CB, yeah, looking forward to getting together in person and
New York.
looking forward to getting your take on everything going on right now and what your clients are hearing and seeing. Vice Capital has been a long time, like literally going back to when we had 6 members at TMC, preferred partner at TMC, our favorite hedge advisory firm, and so many happy clients within the Mortgage Collaborative National Network of lender members that you guys are helping out. And all seriousness, really, really appreciate the partnership, all you do for the members and the guidance that you gave me as a young secondary guy when I was a client, and that I know you're giving our clients when they go through times like this, because it's a tough time to be a secondary guy or gal right now after a couple easy years.
It really is. It's actually, Rich, I was noticing on LinkedIn, I think last week it said you're celebrating your 7-year anniversary at the Mortgage Collaborative. So I guess it was about 7 years ago you made that phone call.
You were my first call, because I'm like, this is the only guy that's going to join when we have 6 members and have some dreams going on because of our relationship and our friendship. And I so appreciate that, honestly. So.
Well, you and the whole team at TMC have really done an incredible job building great value. Just, I mean, and to be able to grow so quickly and still be able to keep all the core values of the organization, still make it feel very, very homey, very intimate. It's really a testament to the culture you guys have put together. So really glad to be a part of it, and glad to be on with you guys. Yes, funny you talked about all the things going on in the market right now. The market's had 200 basis point moves in rate before, but almost never in a period of 6 weeks, right? I mean, this has been about two weeks or maybe 2 months ago, somebody asked me to comment on what was happening in the market. And I said, well, this is nothing. I remember times when mortgages got creamed by 8 points in less than 2 months. Well, guess what happened after that comment? So this is a good old-fashioned Mississippi butt whoop. It really is. That's to have literally 200 basis points in yield in mortgages in 6 weeks is just about, I don't want to say unprecedented because we decided after 2020 we're not using that word anymore, and it's not quite unprecedented, but it's a lot. It's a huge dramatic change, and lenders around the country seem to be, they're faring pretty well. Times are intense, right? Especially if you're a guy or a gal who's a secondary capital markets manager. But for the most part, there's enough folks that are veterans that have seen a lot of this before that they kind of know what to do. You dust off the old book of here's what happens when something extreme happens, and you just try to get through every day the best you can. Make sure that your originators are doing their jobs and locking their loans when borrowers think that they're locked so that they can be covered, and just kind of taking each day as it comes. Today's another day that feels like it's another day, another down 12 ticks in MBS, right?
So I've got a question, Chris. When you said it seems that lenders are faring well, what are you seeing out there?
I think by faring well, it's not that lenders are all happy and things are great, but I'm not hearing a lot of stories of companies that are caught upside down, are falling apart and going from 100 million a month to 10 million a month, some sort of gigantic. So it depends on the company. If you're volume wise compared to 90 days ago, you're kind of in a steady state, or maybe you're a company who's even up a little bit. And there's some that are cut in half depending on how they were getting business and what part of the country they're in. But I'm really more curious as to you guys' take, because you talk to a lot more folks than we do. But for what's happened in the market, again, 200 basis points is a giant punch in the face. It's at least the biggest and sharpest move since 1984 in bonds, and it's global. The global bond indices, I think, are down 11% in the last year, it's really unheard of since they started tracking global rates. But by and large, Rich, I think you could talk about this from the conference you were just at too. People are not panicking. It's a big move. It's happening fast. But it seems that lenders, to me anyway, for the size of a move that it is, feel like they're in a pretty safe boat.
Yeah, I think there's different camps of lenders right now. If you're a really smart company, a really smart independent mortgage banker, I think they view this and any times of great volatility, good or bad, as areas and times of opportunity. I've just seen that through my now 7 years here at TMC. Again, to your point, not that they're happy it's this slow and that you're overstaffed and you got to let people go, but they do see it as an opportunity to gain market share in an industry that is pretty cyclical. You got some people that are a little nervous. I think you got some people that want to sell their company and cash their chips in for sure. And then you got like the depositories, and being in this world, a lot of CEOs and CLOs and CFOs of banks and credit unions they get mortgage, but they don't get it. They love it when it's going great. They don't love
Right.
it when it's not going great. So times like this, working for banks in my life, I used to go out of my way to try to explain the bigger picture. But I think a lot of depository lenders they're nervous that costs are going to get cut, and that things that can cause them to fall behind the curve, from an expense cutting standpoint, could be a reaction to this kind of market from the people that run the bank. So,
Rob, how about on your end? What are you hearing out there in terms of the way that lenders are handling the sudden change?
Well, when you talk about sudden change, obviously that's confined to the capital markets. There's not a lot of sudden change going on with underwriting criteria or the regulatory environment. The changes there are a little more gradual, thankfully. Companies are pretty well hedged up, and I wrote about this a few weeks ago, and Rich, you commented on it. The fact that there are companies out there offering 180 or 360-day locks makes no sense to me. If you go back to very early 2020, none of those loans closed. If you locked in for a year at whatever
not at those terms, right?
Not at those terms. The same thing, if you look at early part of this year and where those rates are now, you're going to get 100% closure. And the question is, how did your company hedge those locks? If you're even offering those locks, and I'm not a fan of long-term locks. Yeah, there's a way to do it. You put on, some coverage 3 months out, and you keep rolling it, and you collect a point or two up front from the borrower and use that for the roll cost and so on. But it's definitely a marketing thing for originators. And once again, we saw how that's a two-edged sword. These long-term locks, the beginning of 2020 or the beginning of 2022, take your pick. But in terms of pipelines and hedging and so forth, yeah, I would say most companies are hedged up. Certainly, it didn't go the other way, and we're not hearing about margin calls this time. That's for sure. The question that I was receiving up until a few weeks ago was how is this going to keep going? How high? And so on. Are we going to have mortgage rates in the 7s or 8s? And I said, no, I think, it's market, nothing goes in a straight line, whether it's the stock market or the bond market or mortgage-backed security prices. We'll level off. And I'm hearing, 5s, maybe 6s, depending on the loan level price adjustments. The big complaints that I'm hearing about, though, Chris, is the two things. First of all, the market has not really caught up with premium pricing for higher coupons, and originators really would like to see some of that, but we're not there yet in the MBS market. And then the second thing I'm hearing about is what the heck's going on with ARM rates? Why haven't ARM rates, why haven't Fannie Mae and Freddie Mac ARM programs really taken off here? What's going on with ARM pricing and so forth? So those are the two big complaints that I'm hearing out there.
Yeah, and very vocally, I'm sure. I got, and I think they're two different things, but they're tied into each other. And the biggest thing that really drives both of those experiences, A, the severe lack of premium that we're suffering, that's getting better now, and B, what's happened in the agency R market are unfamiliarity. It's not just liquidity, I think is the wrong word for it. It's that if you take a look at the premium, look at things like Ginnie and Fannie 5s, especially Ginnie 5s. As an industry, we haven't originated any of those in over 3 years, right? And up until recently, and even now, there's hardly any pools coming out. They're going to be soon, but there's hardly any. So we have a case where we haven't originated any of these for 3 years. And in fact, what we've done is we've refinanced all the people that are in those securities. So there's no universe of 5 or barely a universe or 5.5 securities that are out there for the end buyers. By end buyers, not Chase or Wells Fargo, but the retirement funds, the pension funds, the widows and orphans that love mortgage-backed securities. So nobody's really sure what they ought to be worth, right?
Right. And those widows and orphans have seen their existing holdings drop in value by 10 points.
Yep, absolutely.
So explain that on the balance sheet to the board of directors of the Widows and Orphans Fund in the Monopoly game or wherever.
The good thing I think is that the longer we stay here, the longer that we have lessened volatility, the better it'll be. It's already improved a lot. I take that case of Ginnie 5s. It's a month ago there was no price. Nobody knew what the heck they were worth. And now we're getting to a point where it's not a good market, but there's more of a sense of here's what it should be worth. Here's how I can price it. People are originating them, and that's really going to get better and better. The more that the market stays around here. ARM's really the same thing. It's not that Fannie and Freddie are being greedy and not wanting to put something out there or not sure. The actual ARM securities market itself, which all of Fannie and Freddie's pricing is derived from, it's kind of collapsed. There's nothing out there that's at par or higher. All the ARMs that are out there are 98 and 99. And again, it's a case where when you're an ARM buyer and you just saw the expectations for the Fed funds rate go from, when the Russian invasion of Ukraine happened, it was $1.25 at the end of the year. Now it's 2 3/4. You're just not sure what the heck ARMs should be worth. So, there's a lot of, Rich, you talked about this. There's a lot of ARMs right now being written, but they're not Fannie, Freddie, and Ginnie ARMs. They're only bank and credit union portfolio ARMs. And I think the longer we can stick around this point, the more that we're going to see that securitizable ARM market come back, and the non-banks will be able to better participate in that market too.
Right. Stacy Schwartz asks about FHA ARMs. They fall into the same bucket. Obviously, you've got that government guarantee, but still, if you look at what investors want to own an ARM security or a Ginnie ARM security, given the potential credit risk, you start to enter in other factors that make pricing of those things very difficult. And yeah, we're in uncharted territory. And somebody who was paying 103 for a 3.25% mortgage 2 or 3 months ago, and to have that be down at 93 now, you get very gun shy about wanting to pay 103 or 105 for something in the sixes.
Right.
We get a little downdraft in rates, and that 6% mortgage is going to prepay. So why pay 105 for it? So I'd say investors are skittish, and I think it's important. I try to make that point in my commentary that loan officers need to understand that without that secondary market for these loans, these higher coupon loans, they're not going to trickle down into rate sheets for borrowers.
There are some positives. If you look at credit risk, and delinquencies are very low. Credit risk in general is very low, the way loans are underwritten right now. Chris, could you see, I remember like back in the early 2000s when 30-year fixed rates were around this level. I remember selling ARMs, 5-year ARMs, 3-year ARMs, in the twos, and with handles in the 2s and the 3s for 102.8, 103, 103.2. Could you see that coming back? I know they have additional prepay risk, but the flip side of that also is if rates continue to go up or stay at these levels, which is certainly possible, those assets, as they get closer to the first roll date, they're going to go up in rates. So they start to have additional value that starts to offset that prepay risk. Could you see the ARM market? What's your thoughts on just the ARM market in general?
I do think the securitizable ARM market, which flows right through to everybody else, this non-portfolio, I do think it comes back. We need some stability. If you look actually as recently as the end of last year, there were plenty of ARMs that are being traded for a 101.5, 102. You put in a decent value of servicing and you can originate a 0-point loan, even with a cost structure that isn't super skinny. So I think some stability is going to help bring some of those premiums back when people have a chance to say, okay, I think I know what the next 2 years, the next 3 years are going to look like. The other part of it too is, ARMs ARMs are great when you have a steep yield curve, right? When the cost of short-term money is a lot cheaper than the cost of long-term money. And right now you might think, well, don't we have a steep yield curve? The Fed funds rate's still only 40 basis points, and the 10-year treasury is at 275, but we really don't have a steep yield curve. It's only at the very, very short term. We're going to have a Fed funds rate that's going to be in the high 2s in only a few months. So, the market anyway, regardless of what you think of inflation, whether it's here to stay, whether it's not, the market itself isn't worried about it. We have a 10-year treasury at 285, the 5-year at right around the same level, and the 30-year only at 295. So you're only getting an extra 10 basis points as a bondholder to hold a US treasury for 30 years compared to 10. So really, other than the Fed funds rate, super short term, the yield curve is actually really gosh darn flat. So it's a bummer that the whole time the ARMs could have been great. Well, nobody wanted them because fixed rate loans were 3%. So now fixed rate loans go to 5%, and unfortunately with ARMs, there's no premium to be found at all right now. But I do think that'll get better as the year goes on, and the market gets used to what the new normal is that we've adjusted to rate wise so quickly.
This is the Rundown with Rob and Rich. This week, happy to be joined by Vice Capital Markets founder and president, Chris Bennett, talking about just the interest rate climate, capital markets, and any comments, questions, thoughts anybody has, please put them in the chat or the Q&A on this very top of mind topic right now. And seeing some stuff starting to float in there. Chris, a question came in on lock and shop programs, which has been a big topic of conversation amongst our members, both on the virtual working group calls we do in Miami a month ago. Rob spoke to some of the complexities of pricing out 180-day and 360-day locks, but a lot of lenders talking right now about like a lock and shop program. You allow somebody to lock their rate in now that thinks rates are going to go up more for 90 or 120 days, and essentially give them a pre-approval on that rate lock to go hunt for a house. You seeing clients do that? It's a little bit easier to price that out, right? You just got to price in the additional kind of.
It is, and I think there's no kind of one size fits all when it comes to lock and shop. You've got to know your company. You got to know how your loan officers are going to use that, and it's something that, to my mind, I think it needs to be done very carefully, and it needs to be done within some pretty restrictive parameters. Like personally, I like an idea of it's a 90-day lock and shop. You got 45 days to sign a PA. If you don't sign a PA within 45 days, all bets are off. You're starting over brand new. I'd love to say as a risk management guy that, hey, you got to pay X amount up front or whatever, but that just doesn't work. What you really need to do is kind of recognize that, hey, you may take a little bit of a hit on some of these, but this is a great tool for your loan officers who are out there trying to compete. They've got realtor relationships. And this whole time they're competing in a very, very tough market of they've got a relationship and somebody says, hey, I got this from givemeamortgagetoday.com. How are you going to beat that? So it's a great way to, in my opinion, work with your realtors you have these good relationships with and say, hey, you're a buyer's agent. You've got somebody. I can hook you up, introduce them to me. This is what I can do. Now we got 45 days and they can go out there and confidently, we got a pre-approval for them. They can go out there and confidently shop. You got to price this 90-day. You got to be willing to take the risk that they don't find a house. And that is a real risk. But I think by keeping that time frame short, the last thing you want to have is this, especially in an environment where you got 12 offers on every house, you got 3 of them are cash buyers, and you've got a person that just over and over and over again gets rejected. And after 3 months, they're kind of only half in the game. They're disgruntled. They're disappointed. But you can't, as a mortgage lender, be on the hook for this interest rate forever. So I think it's got to be done as not a loss leader, but knowing that there's a much bigger picture than just the revenue you're getting on this one loan. It's about providing a tool to your originators, but making it something that's useful, but also caps the risk of the company.
And not surprisingly, we're seeing ARMs start to be a bigger part of the picture. The MBA's recent application data, ARM applications almost doubled week over week, going from 9 to 17%. Anecdotally, talking to some lenders this week at Texas MBA and just some of our members, we're hearing more recently 20, 25%. Some of our bank members that are able to put some of that stuff on the shelves at pretty competitive rates, we're hearing 40, 50% of new apps. So it's a new type of market right now. We haven't even talked about ARMs for years. And again, there's not really a lot of very viable alternatives on the secondary market right now. So it's a big advantage for the depositories right now in terms of trying to win new business.
How many banks do you think are there out there that they have through ALCO or whatever, they have a meeting once a month to adjust their portfolio rates? And some of these rates look really, really darn attractive because people have been on vacation. They haven't had a meeting to talk about rates in 6 weeks. I don't know. Different banks are different.
Yeah. I mean, banks have put like no loans on the shelves, honestly, these last 2 years. Like I've just heard that from our bank members, like we need more earning assets. But you don't want to put like 30-year fixed rate stuff at 2.5% on the books, which is what everybody wanted the last 2 years because of the interest rate risk that poses. And like right now, you'd be writing that stuff down to how many ever cents on the dollar. But now it's kind of the flip side. They're like banks that have put aggressive ARM rates out there. It's been popular, obviously, and all of our independent mortgage bank members are asking, man, they should offer that correspondent.
They'd have a lot of takers if they do.
Rob, I know you do some consulting work. You didn't consult Matt Ishby on his LinkedIn post this week, grave dancing on the Rocket layoffs, did you?
I did not. I didn't see that post. I don't. Is LinkedIn a social media platform? My son Robbie actually handles my LinkedIn account. So
not surprising. Well, you know,
what did he have?
Well, voluntary buyouts and not layoffs, but yeah, then he called it disgusting. But it just, I cry inside for the sycophants that reply to his posts and like trump him up like he's a good human.
But Rich, don't you want to, you know, in this, everyone's looking for yield on their investments. Wouldn't you want to buy some Loan Depot stock or some United Wholesale stock and earn a dividend of 9 or 10% on your money?
What's the stock? $2 a share? I mean, you know, it's like
No, I'm just obviously kidding, but it's one thing for companies to do well, and you want those companies to succeed. You don't mind if they succeed, put it that way. I mean, they're a competitor, but they hold their head high and they're doing the right thing and they do it honorably. And there are companies out there that people would just as soon see fail. And better.com jumps to mind, for example. It's really too bad that those people get laid off. Everyone's going through layoffs, but the way that they did it and leading up to it, just their pricing practices and their policies and their just corporate behavior, I think didn't lend itself to having many friends in the industry. So better.com faltering here a little bit. You know, whether or not you put United Wholesale into that category remains to be seen. I know where you are, but you know, there are companies out there, and you can constructively compete, and or not. And I think when you go to these conferences, for example, and you see friendly competitors chatting away, normally those companies are constructively competing against one another, and you genuinely like the other people at the company, you know, at your competitor. Heck, you might end up working for them or them for you at some point, but other companies aren't doing that. So I don't whatever, you know, Matt's like this cocky little Bantam rooster out there making waves, and
it's angry little guy. Yeah, it's just, man,
that's his shtick, right? That's his deal.
Yeah, well, I had to get that in, but you know, shifting the topic here.
At least you didn't say your boy Matt, Rob. That's you. You know what I was thinking about? Maybe I should, you know, we've got all these people on the screen that have just their names, and maybe I should like get my mug off the camera and just like I'll continue to participate, but let you guys look out the window. What do you think?
See, the magic dragon.
Does it make sense? Would you rather look at that than me?
Yeah, if we see a plume of smoke come in front of the videos,
we'll know what's going on then.
You're not fooling anybody. You're safe from the dogs. By the way, we got a shout out, the rundown in with some column that was writing about the best multimedia mortgage programs. And the comment was, you know, funny, witty, and they amazingly managed to work drug dogs into every episode. If you're on LinkedIn, you would have.
Hey, Rich, the drug dogs here actually carry the drugs to, you know, distant outposts on the island.
Chris, Jerome Powell, what grade would you give Jerome Powell right now in his tenure as Fed chairman? You
know, it's funny. I only get one magazine. So I have a favorite magazine, but it's also the only magazine I get is The Economist. And last week's cover is entitled "The Fed That Failed." And I think that's probably, it seems harsh because of course hindsight's always 20/20, right? And it's difficult. I think part of me last year is Chairman Powell wants to get renominated for another term. So he's got to be very dovish. And then suddenly we get to the point where that's all in the bag. And now we have, first it's a supply shock, right, from COVID. But now it's not going away. Now you throw the war in Ukraine on top of it. But even before then, when you have, you know, the Fed's got 40 years of inflation fighting credibility, right, behind it. That's what enables us to have such low interest rates. And that can all be lost in the span of just 6 or 12 months. And so they're really behind the 8 ball. They know it. And it's not a matter, it's difficult when there's a supply shock. the Fed can do a good job at stimulating aggregate demand or holding down aggregate demand. The Fed can't do a whole lot about supply shocks. But what they can do is stop pouring gasoline onto the fire, right? And you can certainly say we should have stopped pouring gasoline onto the fire 8 or 12 months ago. So, I mean, I guess hindsight's 2020. I'd give them a C-, I think, right now. And they've got time to make up for it. And it looks like, what they're doing now of, first it's like, well, we'll do a quarter, maybe every other meeting, maybe it's a quarter every meeting, maybe it'll be 50. Now the market's talking about 50 and 75 and 75. But in the end, Rich, I kind of think that's okay. In the end, we made this huge adjustment where we know by the end of the year, we're going to be at 275, or next year, we're whatever we're going to be. Let's just do it now. Rip the Band-Aid off. There's no reason to pussyfoot around with quarters and every other meeting or every other meeting. Let's just stop, squirting gas onto the fire. And they're finally getting around to that, but it really seems like too little too late to me. And now we had a $9 trillion balance sheet. What do we do the next time that we need it, right? It's the Fed's trying to engineer this soft landing, and I think there's only been 3 times in the last 60 years, if I remember right, that the Fed has raised rates without actually causing a recession. And there's a growing camp that says, I'm sure Gary Wolf would be in this, that you mentioned, of, there comes a point where inflation can get so bad, the only way to actually quash it is to cause a recession. And we might be going down that path. I hope not, but we might be going down that path. What do you think?
I don't, Chris, I don't see that happening.
No.
People talk about these recession, the recession. At some point they'll be right, but I continue to see, and Rich, you probably saw it in Austin, and I've been doing some traveling recently, or all the time, and I keep beating this drum that the restaurants are full and they're charging huge amounts for less food, and the airport parking lots are full, and you go into a store and you want to buy ping pong balls for your cat to play with, and they're out of stock with ping pong balls, and so there's still supply chain issues. You go to Costco and they limit you to 1 bag of dog food. I just don't see a recession happening. There are people out there who continue to want to spend and don't mind travel. They want to travel and they want to go out and they want to buy watches and neckties and so on and so forth. I just don't see a recession looming. And when you talk about the last 2 years, because the savings rate went up so high into the mid 20s, I think people save so much money. Yeah, they're eating into their savings now. So at some point that may come to an end. But for now, I think people just want to spend. So
we kind of saw that in the GDP number, right? GDP that just came out for the first quarter was down 1.4%. But what happened? Bonds sold off and stocks rallied because it was that we spent lots of money as consumers. We imported a lot of stuff. We didn't produce a heck of a lot, but we spent a lot of money, to your point. People have saved a lot, and people's priorities maybe be a little bit changed in the last couple of years. I don't know if you agree on that or not, but we've got a reduced workforce, and I don't think it's going to change. People are saying there's more to life than just working 40 hours a week. I'm going to go out and I'm going to enjoy it.
Boy, I don't know who has that mentality. Van life. I was talking to somebody who lives in Bend, Oregon, and they said, "Oh, Bend is where young people go to retire." And sure enough, you have very low unemployment rate. I mean, the unemployment rate is in the 3s. I mean, how much lower can it go? And yeah, I think priorities have changed to a great degree. So maybe you don't need a new wristwatch, but you want to take the family to Switzerland, kind of thing.
This is The Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Krisman. This week, pleased to be joined by the founder and president of Vice Capital Markets, excellent hedge advisory firm out of Michigan that so many of our members are happy clients of, and always love to get Chris's perspective on the interest rate climate and the capital markets. And my prediction is that we may not statistically get a recession, but for a lot of Americans, it's going to feel even worse than that. We're going to get this barbell thing. I see and feel the gap between the haves and the have-nots widening, not just with housing, where you can't buy a house to save your life under $300,000 anywhere, or rent one affordably. And all these more expensive price houses that are going on the market are getting gobbled up in hours. but just more broadly with the economy. Ironically, under a Democratic presidency, and not because of policies that they're espousing, but through monetary stuff, Fed actions, and the housing market and things that are going on with housing, a supply issue that has been a problem for a long time and just gets worse and worse with no relief in sight. So we'll see what happens. But
kind of along those lines, Rich, I was at a MBA Strathmore peer group series of meetings recently, and I heard, I forget who said it, but when I mentioned the savings rate over the last couple of years entering into the mid-20s, lenders and vendors are in that same boat. And somebody said that we were talking about signing bonuses and retention bonuses and what some of the companies are doing out there. And I heard the term, this, a company is weaponizing their savings. And meaning that they're taking their savings over the last few years and their profits, and they're turning them into a weapon to raid other companies of their top producers. And I thought that was a very interesting term when you talk about the lenders and the lending environment out there, and whether it's individuals or families, what they're doing with their money, or what companies, lenders are doing with their money. They're weaponizing their earnings and using that to try to gain market share, because obviously the overall pie isn't increasing. So you have to increase your share of the market, or else.
Do you hear it's kind of funny with signing bonuses. I meet very, very few people. I don't even know if I can count them on one hand that said, yeah, I've been with this, I joined this company 8 years ago from a signing bonus, and I've been here ever since. It seems to me anybody who has a signing bonus did the same thing last year and the year before and the year before that.
No, it's a mercenary type of mentality.
Mm-hmm.
Well, it was like, you're the very astute comment that you posted in your commentary a couple of weeks ago that I replied back to, somebody that was in disbelief as to the inconsistent and over aggressive business practices and pricing that. Listen, you got just insanely wealthy prior to the last 2 years of refi business owners, insanely competitive. It's no different than in sports. These guys that buy teams and go out and just spend truckloads of money because they want to win, right? And they want to, and it's no different in the mortgage industry on a smaller scale. You've got 70% of the market share right now being done by independent mortgage banks. Some big ones have gone public now, but most of them, the vast majority, are privately owned by people of varying wealth. Some are incredibly wealthy and incredibly competitive. And yeah, so when it comes to pricing illogically or throwing stupid money at loan originators, you're always going to see that. You're especially going to see it off the heels of the 2 biggest years in the history of the mortgage industry. So it is what it is. So
yeah, weaponizing savings. I like that.
It's true though. It is weapon.
Yeah, it is.
It is fascinating the difference in how lenders are using the profits of the last 2 years, which have been exorbitant. Some that are more conservative, kind of stowing it away and battening down the hatches for what could be a few rough years ahead. Some are spending like drunken sailors on LOs and tech and everything else. And it's all over the board. So, so Chris, explain, everybody here, interest rates have been the soup of the day in the mortgage industry for a long time. And, it's amazing to me how much I still hear though from industry people. Oh, the Fed's, rates are going to go up even higher because the Fed's raising 5 or 6 more. It's just a brief synopsis of how all this is priced in, like all the expectations of Fed hikes, probably plus a little bit, is already priced into the interest rates we're seeing. I'm trying to give people some hope for the interest rate environment this year.
You're absolutely right. And I think sometimes a good way to look at it is mortgages often will follow something, a 5-year or 7-year treasury, because on average mortgages last 5 to 7 years. And so really those rates are the accumulation of what are my expectations for the Fed funds rate in every one of those quarters over the next 5 or 6 years. So you're right, even though the Fed funds rate is only 40 basis points now and soon to go up and up and up and up, the 5-year treasury at 275 or 285 is based on not what it is now, but what all those expectations are going forward. And the reason that we've had the big move that we've had, certainly in mortgages, are because those expectations changed. You know, and a lot of them changed because of the Fed guidance themselves. The Fed has these dot plots where the Fed governors, the FOMC anyway, all gets together and says, here's what we think. You know, they want to be so transparent. They literally want to know, they want everyone to know what their guesses about the future are. Used to be a long time ago with the Fed. They didn't even tell you when they raised rates. You just kind of figured it out when the market started moving. But now they want to make sure they're very transparent. Everybody knows everything. But the Fed's own guesses, the Fed's own dot plots have changed dramatically in the last 3 to 4 months. They kind of give the market a taste of, well, if we were to do this, what would you think? And the market digests it. They say, all right, well, we might do that. Maybe we'll do this. So is everything baked in right now? It is. But what could happen is the market could decide, and the Fed might even decide to telegraph that going to 3.25 isn't enough, that the market might expect more, 4, 5%. It seems unheard of. It's such a large move. But prior to the 2008 crash, the Fed funds rate was 5.75. And at the time, Bill Gross came out and said he expected it to go to 6.5 right before the financial crisis. So we've had a series of super low rates for a really long period of time, but we can also have periods of time. I don't know that we will, but the Fed funds rate can really be anywhere, depending on if the Fed thinks that their ability to fight inflation, if they're really continuing to lose that credibility battle. I hope not. That'd really be a huge move, but that'd be, but like you said, Rich, the current situation, the current expectations, they are all baked into the cake. So we don't have to go higher just because the Fed funds rate's going higher.
It's so inflation based right now. Like, anybody asks me, like, what do I look for clues as to what the interest rate climate's going to be like short term or medium term? Right now, it's really so inflation related right now, right? I mean, if the next major inflation number we get, and it's not what it is, inflation's high right now. The next number is going to be high. The next several numbers are going to be high. It's really what is the reading versus economist expectations, because that's kind of what's priced into the market. So if we get an inflation number, some people feel like inflation may have peaked. If those people are right, and we get an inflation number coming up here I think it's next week or the week after, that is a little bit less than what economists are projecting, we could see a big rally in the mortgage bond markets and a drop in rates that's pretty significant.
Yeah, one thing that'll work a little bit in our favor from an inflation number standpoint is we love to look at year over year changes in CPI. And that CPI it's an index. It's 212, it's 212.3, it's 212.4. It's an index. And so you measure what's the change compared to a year ago this month. And we saw a huge surge in inflation that happened about, I guess, a big change in price about 12 months ago. So we're finally getting to the point where that initial bubble is kind of already there. So when we measure the price level now compared to 12 months ago, we're now measuring against a level that's already risen. So that doesn't mean that we go back to zero or anything like that, because those price pressures, like Rob was talking about, people are starting to expect that they can raise their prices. Where before it was, well, businesses, we're just happy to be able to make it. Now people feel kind of more aggressive about continuing to raise prices. But at least now when we're comparing and we're looking at year over year figures, we're comparing it with a period of a year ago where that inflation was already there, where we already had increases in those price levels.
Some comments in the chat. Our friend Tom Lamafa about first quarter GDP being misleading. The key component consumption was strong. And yeah, exactly. And that's why stocks rally off an unexpected 1% drop in GDP. And also a comment, did you see the recent NAR study that said housing investment from 2010 to 2020 has also only benefited the affluent? That does not surprise me at all. I think a lot of housing policies directly or indirectly have benefited the affluent. And I saw this week, National Association of Real Estate Brokers, NAREB, they came out and they're calling for a $10 billion down payment assistance grant, which to me would just be gassing the supply demand fire. Like, how can people be so dumb? There are ways to help nudge the supply issue that everybody's
plan.
The Swerbinsky, like, why the NAREB people, why are they not advocating putting 10 billion towards something that would put more homes on the market, as opposed to down payment assistance that would just make it even more competitive for people at the low end than the two houses nationally that are under 200,000 that are for sale? I don't understand that. It is completely befuddling to me, but
that is what we need: 10 billion or 100 billion in new home construction.
The cost of doing nothing at this point is going to end up being very expensive if it isn't already, because at this point, I can't believe it's not a bigger story, but I'm a broken record on this topic. So, Rob, did you read the full Fannie and Freddie duty to serve plans? They were 400 pages. Is that what you're doing?
I'm about halfway through.
There's a lot of manufactured housing stuff and some manufactured rural and preservation of affordable housing seem to be the notable things in there. But yeah, even with all that stuff, it's the supply issue is a tough one to try to figure out. And you broke another M&A story this morning. You're kicking your, I guess you're not even really competition, but the mortgage media people. You're breaking everything. Planet buys Home Point Correspondent.
Yeah, it's a sign of the times, right?
Mm-hmm.
I know several wholesale. Well, never. Yeah. I think we'll see more of that.
Yeah,
I think companies are evaluating their business channels, and during the last couple of years, there was so much business that it's like, oh, let's open up a direct consumer, let's open up a reverse, let's open up a wholesale, let's open up a correspondent channel. And I think now, with the shrinking margins and shrinking volume, companies are going back and saying, gee, do we really need fill in the blank?
Mm-hmm.
So I think we'll see more of that as the year goes on.
Certainly. And getting short on time, but Chris, want to get inside your head. Just, it's tough to make predictions. Rob hates predictions. I'd love making them. I love making fun of people that make horrible ones because they're all wrong. These economists in the mortgage industry, it's just the safe, boring, there's never anything to them other than what you expect. But the general interest rate climate and the Fed, you're as dialed into this as anybody I know. I know it sucks when you get put on the spot to predict, where rates are going to go and what's going to happen this year, but your just general sense and gut instinct, having been in and around the capital markets your entire life, as to how this year plays out from a rate.
Yeah, you're right. I really avoid trying to make predictions because I think when you predict something, you lock yourself into a preconceived notion about the future, and then it's hard to change gears. And if I knew what was going to happen, I'd be living on a private island somewhere, right?
Like Barry Habib, but his prediction. Right.
One thing I do think, it's been such an incredible shock in the markets in interest rates. 200 basis points in 6 weeks is big. So I think as time goes on, as we get more used to being in this area, we will see things like premiums return for conventional and government loans. We'll start to see ARM premiums return on Fannie, Freddie, and Ginnie. I think it's going to be slow, but we'll start to see those return. Again, with the yield curve truly being flat, what we're talking about, they might not be super attractive, but that is going to get better. So I think the violent part of this move is out. I don't know where it shakes out in terms of what's the final Fed funds rate we end up with 2 years from now. It's really hard to say. The market, I think one of the things to me is to, instead of listening to economists, look at what the market says. Don't listen to what an economist says Fed funds will be. There's a gigantic, crazy, multi-trillion-dollar market of people who bet on that. Look at what they're betting on. They're the people with all the money. It doesn't matter what an economist says. It matters where people will put their money. So to my mind, that's the best place to look. One thing, I guess, if I have a piece of advice to give originators, mortgage bankers, it's my friend Aaron Palmer says, speed is life. With what the cost of time is right now, the difference between Fed funds and mortgage rates, which is that roll cost, the difference between a 30-day lock and a 60-day lock, it's 50 basis points. If your company can close loans in 30 days and your competitor closes loans in 60 days, you have a half a point advantage in the marketplace right now. That's one of the things I think, if you're going to ask what should people focus on, I think that's one of the things that people should focus on. So that's my take anyway.
Very sage advice. Follow the markets, follow the money, and not Barry Habib. Rob, any closing words of wisdom for us from the beautiful islands of Hawaii, and Puff the Magic Dragon out there?
Buy low, stay high.
Buy low, stay high. I like that. I'm reusing that joke.
Feel free.
Your Warriors.
Yeah.
Memphis, that's going to be an exciting series. I'm looking
Oh, is
forward.
it Memphis is the,
Yeah, they got to win tonight. The game 9 o'clock tonight. They play Minnesota, but I hope they win because that Golden State Memphis would be fast paced and fun series. So
yeah. The Warriors, I have hope, I hope they would beat them. So, yeah.
Yeah.
Rich, what are you doing this weekend?
this weekend, really no plans. Youth baseball tournament spectating, and getting some stuff done around the house, and mixing a little NBA playoffs, and hopefully my Guardians can stop their 7-game losing streak that's got me in a state of depression right now. So, but
it's early still.
But it's early. Yeah, it's early. So, CB, plans for the weekend? Anything good?
I'm gonna play some golf badly. That's my plan.
Aiden Hutchinson, you're gonna get him out there?
Yeah. He might be a little busy for me, but we'll see. I don't know what his handicap is. Well, if I can sandbag my handicap, he's gonna have a lot of money. He can bet a lot now, right?
His handicap is he went to Michigan.
By the way, so this isn't a Toledo shirt. This is a Toledo War Champs shirt. Most people don't know this. In the 1830s, Ohio and Michigan fought an actual war. 1,000 people lined up on either side of the Maumee River in Toledo. And even though Andrew Jackson awarded the Toledo Strip to Ohio because Ohio had votes in Congress and Michigan was a territory, we got the Upper Peninsula as compensation. So we actually were the Toledo War Champs. Hence my shirt.
Now, that's a sports rivalry where you will get people lined up ready to go to war. Ohio State, Michigan, there's no better rivalry. Old Buckeye coach Woody Hayes, his car ran out of gas at Michigan border. He walked it across the border in neutral because he refused to spend money in the state of Michigan. It's like that's a real rivalry, right? That's so. But excellent. Well, Rob, Chris, as always, thank you. Chris, thank you for your partnership, long time with TMC, Vice Capital Markets. Google them. Ask anybody on our team about Vice Capital. If you're not using a hedge advisory firm and are up in that couple $100 million a year range, wise advice, especially times like this. And Chris was like my college degree in a lot of ways as a young secondary guy. Getting to pick his brain on a probably more than he was comfortable basis as a former client. So really appreciate you and Vice Capital, Chris.
Hey, thank you, Rich. Thank you guys both. I feel smarter just for sharing the same screen with you.
And Rob, as always, good seeing you. Enjoy. How long are you in Hawaii?
About a week.
Wow. I want your life. I
Yeah,
say that
enjoy that.
every week. I bitch about the supply issue and I say I want to be Rob Krisman.
Now, can you hear that thing in the background of the rooster? A quick bit of trivia. 1982 Hurricane Iowa, whatever, a hurricane roared through the island and destroyed all the chicken coops and set the chickens free. And for the last 40 years, they have been propagating and populating the island. So you can't, as soon as you land and you walk into the airport, there's chickens in the baggage claim area. And it is amazing. There's chickens everywhere.
Really? That's
Yeah.
fascinating. So,
And they're very wary. It's not like you can go pet them.
it is one of the number one food items on the American menu. I don't blame it. Honestly, I'd be nervous too.
Chickens outnumber people 3-1.
Excellent. And to our attendees, thanks as always for wrapping the week up with us. We're here every Friday at 3 p.m. Eastern for the Rundown with Rob and Rich. Find us on YouTube. Find us on podcast, Apple, Spotify, all the podcast platforms under TMC Connect. Search us, find us. That's where most of you listen to us. And have a great weekend, everyone. Take care. Bye, Chris. Bye, Rob.
Thanks, everybody. Thanks, guys.